Good evening, all of you, my dear students. Myself, Panindra. I'm a practicing chartered accountant. I'm going to deal with the paper Strategic Financial Management at CMA final level, which is paper number 14. So, I need to explain the approach of this particular subject, how to approach this subject, and how to understand this subject. So, I'm going to explain the teaching approach and how you need to understand this particular subject. I'll explain. Okay. Why? Because we need to travel for a while to understand this subject. Definitely you need to understand the approach of my teaching. Okay, so I'll take very less time for this. See, basically this subject strategic financial management is loaded with so many formulas. So if you by heart the formulas, you cannot apply such formulas in the examination when you are handling the problems. So first of all, you have to understand the interpretation and conceptual background of every formula. So I'll explain the conceptual background of every formula, and also with the help of numerical examples I'll explain, so that you can easily understand every formula. Sometimes if required, I'm going to give you the derivation of every formula, but for some of the statistical formulas like in the chapter portfolio management and in some of the chapters like derivatives, I cannot give you the derivations. Why? Because such derivations requires a lot of statistical derivations, which is not at all required for the examination. So only for few formulas I'm going to give you the reasonable derivation part. Okay, then, and also basically this is a problematic part, problematic paper. You need to handle lengthy problems. Okay, so the big thing is you have to understand the problem. Merely by reading the formulas, you cannot simply solve the problems. Why? Because the approach is very important for the problems. If you cannot approach the problem properly, you cannot handle the problems. Okay, so if you want to solve the problems, first of all, you'd be able to read the question properly and get the data properly, and also understand the requirement in the question. Accordingly, apply the data. Why? Because they may give you 10 points. Out of that, you just need 6 points only. The other 4 points may be irrelevant, which is not at all required for your solution. So based on requirement, I should get the data, and we should solve the problems. So my dear students, I'll give you the approach how to read the question and how to get the required data in order to solve the requirement in the question. Okay, so this is my approach. So the simplification is very much important. Okay, and also I'm going to give you the simplified solution for every problem. You know, my dear students, the solutions which were given in the study material are very complicated. Sometimes those solutions are you cannot easily understand by merely seeing the solution. So don't focus on the solutions which were given in the study material. I'm going to give you the simplified solutions to every problem in our own style. Okay, so which is always suitable to the examination standard also. So you don't bother about the solution. I'll give you the solution in a simplified manner, that too in a stepwise manner. Okay, and the next thing is, you know, some of the concepts you cannot understand easily. So I'll give you the stepwise process for understanding such complicated concepts. So this is my way of teaching. So the first area is what? Interpretation and explanation, conceptual explanation of every formula with the help of numerical examples, and also I'll give you the approach to read the problem and how to get the data and how to apply such relevant data to the requirement in the question, so that you can simply solve the question within in a very less time. Okay, and also giving simplified solutions is my own style. So simply you cannot understand the solutions in the study material. I'll give my own solutions. If you can follow such solutions, you will definitely get good marks in the examination. And also I'll give you the stepwise process for every complicated concept. Okay, and then in my teaching, what kind of problems I'm going to cover. So this is the first area, the coverage of problems. You know, my dear students, in our classroom discussion, I'll cover every illustration. Along with that, additional illustrations will be covered, and we are going to solve every solved case study, and I'll take up these past examination questions also, so that we'll get complete grip over the concept along with the problems. But our study material is loaded with so many problems, it is very difficult for you to cover every problem in the in our classroom itself. So I'll give you the printed solution for comprehensive problems and unsolved case studies. Actually, these problems are given just for the practice purpose, and for these problems I'll give you the printed solutions. You don't bother about it. See, and also sometimes I'll take some of the problems on comprehensive problems if it is required, but in most of the cases I'll give you the printed solutions. So in our classroom discussion, I'm going to cover illustrations, additional illustrations, solved case study, and past examination questions, and I'll give you the printed solutions for comprehensive problems and unsolved case study. You know, my dear students, the problems in the study material are classified into illustrations, additional illustrations, solved case study, and then what, comprehensive problems and unsolved case study. Additionally, I've added what, the past examination questions along with RTPs and MTPs also. Okay, yes. Now, and also we need to cover the theory concepts. Why? Because in the MCQs, in the main examination, and the MCQs along with problematic part, they'll also give you some theoretical based concepts and they'll give you MCQs based on theoretical concepts also. So I'm going to cover such theoretical concepts separately. Okay, so this is regarding my teaching approach. So let us understand the weightage of each topic. This is a prerequisite. Why? Because you need to focus more on some of the important topics, and some of the topics may carry less weightage. You need to give little importance to such topics at the time of preparation also, and even at the time of revision just before the examination, you should understand the weightage of each topic. You know, my dear students, this weightage is strictly given in the study material. I'm just following it. Why? Because in the main examination also they're following these standards. That is the weightage which is given in the study material, they're strictly following it. Okay, in one of the examination they have deviated, but still in the recent examination they've strictly followed this ratios. Nothing but the weightage. Okay, these are the chapters I'm going to deal. Look at the chapter names, my dear students. Some of the chapters are very familiar to you. Why? Because those topics were covered at CMA inter level also. If you look at the first chapter, investment decisions, project planning and control, this chapter is already covered at CMA inter level. Apart from that, remaining all chapters are new to these are new chapters for us. Okay, look at the chapter. First chapter, investment decisions, project planning and control. I'll give you an overview of every topic in a simplified way. Investment decisions, project planning and control. This is a CMA inter topic. Under this topic, how to select the projects and application of several capital busting techniques, which deals with selection of the projects like expansion projects, diversification projects, cost reduction projects, replacement decisions. This type of concepts we need to understand. So this chapter deals with selection of the projects, and we are going to deal with cost benefit analysis. Now look at the second chapter, evaluation of risky proposals for investment decisions. You know, my dear students, in this particular chapter, this is nothing but capital busting, but with risk. Actually, at CMA inter level, we have selected every project merely by using what? The written concepts only. Nothing but NPV, IRR, profitability index. These are all written based concepts only, and we are going to select the projects with high return only, and we ignore risk factor at CMA inter level. But at CMA final level, we are going to incorporate risk in our investment decision process. Simply speaking, while taking investment decision, how to consider risk and how to consider this return. You should compare risk and return at a time, and accordingly you should select the projects. So evaluation of risky proposals for investment decisions, nothing but risk analysis in capital busting, risk analysis in investment decisions. So while selecting the project along with return NPV, I should also consider the risk. So accordingly I'll select the project. At the time of selecting the projects, you should consider risk as well as return. So these concepts I'm going to cover under the chapter evaluation of risky proposals for investment decisions. Under this chapter, we need to understand several statistical and non-statistical techniques like standard deviation, coefficient of variation, probability distribution approaches, decision tree, simulation. Like that, there are several new concepts which we need to deal with. Okay, and then if you go for the next chapter, leasing decisions, you know, already you're very familiar with this term leasing because this is covered at a CMA inter and CMA inter level. And one of the accounting standard covered this particular concept called leasing. So, but here I'm not going to discuss about accounting treatment. I'm going to discuss about the decision making area in leasing. Nothing but from lessor's perspective and from lessee's perspective, we have to take decisions, because our subject strategic financial management predominantly deals with decision making only. We are nowhere concerned with what the accounting treatment. So my dear students, under the chapter leasing decisions, from lessor's perspective, whether this investment in asset for leasing purpose is viable or not, we need to deal with that. And then from lessee's perspective, going for buying of the asset or leasing of the asset, so which one is beneficial to the lessee, that's what we need to take. We need to take a decision related from lessee's perspective, lease or buy decision. And also we need to understand several new concepts like break even, lease rental calculation, like that. Okay, so this is regarding leasing decisions, decision making from lessor's perspective and lessee's perspective, leasing. Okay, securitization is a theoretical concept, the mechanism, the participants, and then the securitization instruments. This is a theoretical concept we need to deal. So this is regarding the first part, investment decisions. This is covering nearly 25% of the marks. So out of 100, we are going to get 25 marks for these topics. And these are very familiar topics and easy topics, in fact. Why? Because one topic is already covered at CMA interlevel. So definitely you can easily handle this particular topic. Okay. So, and also this evaluation of risky proposals for investment decisions and leasing decisions, these are very easy topics. You can easily get 25 out of 100 by preparing this particular area called section A, investment decisions. Okay. Now I am moving to the second area. From this area onwards, every concept is new to you. Okay. So look at the concept. It is security analysis and portfolio management. Yes. Here is the concept. Equity and bond valuation and evaluation of performance. So equity valuation and bond valuation. You know, at CMA inter level itself, we understood value of equity. If you remember, the formula for MP naught, value of equity, is DPS 1 by KE minus C. Even at capital structure even in the chapter capital structure, we understood how to calculate value of equity, earnings available to equity shareholders divided by KE. You know, my dear students, but valuation of equity is a big concept. We have so many formulas, plenty of formulas for calculating value of equity. See, in dividend policy, we have several formulas for calculating value of equity, like Walters model, Gordon model, and Modiglian and Miller approach. Like that, we have several formulas. So in this chapter, I'm going to deal with every formula relating to value of equity. We need to understand free cash flows approach. We need to understand dividend growth model, Gordon model, Walter model, multiple growth rate level model. Like that, there are several approaches for calculating the value of equity. That's what we need to understand. So this chapter, equity valuation and bond valuation, these are two separate concepts, equity valuation, bond valuation. Equity valuation purely deals with what? Value of equity under several approaches. Okay, purely the application of several formulas, you can easily understand. And then coming to bond valuation, which deals with value of bond. So what is bond? Bond is nothing but just like debenture. So you need to calculate value of bond, a financial asset. So while calculating the value of the bond, such bonds are classified into several types, like plain bonds, coupon bonds, and perpetual bonds, annuity bonds, zero coupon bonds. Like that, we have several type of bonds, and for every bond, you should be able to calculate value. And also for these bonds, since it's a financial asset investment, financial instrument, you should calculate the return to the investor, which is nothing but YTM, yield to maturity. And also we need to deal with several strategies like bond immunization strategy. And also we need to deal with callable bonds concept. So these are the areas which we need to cover under the chapter bond valuation. So, and also we need to assess the performance of these financial instruments, whether they are giving better return or not. Evaluation of performance, this will be covered under this chapter, equity and bond valuation. Coming to mutual fund, this is a known name to everyone. Mutual funds, this is not a company actually. Mutual fund is a trust actually. Under the chapter mutual fund, what we need to do, see, in any topic, I'm not going to deal with accounting treatment. Under the chapter mutual funds, you need to deal with calculation of NAV, net assess value of units, mutual fund units. And also we need to test the performance of several mutual funds and compare such performance with benchmark mutual fund. So like that, we need to understand several performance measures like Sharpe ratio, Trenner ratio, Morning Star Index model. There are several models like the FEMA's net selectivity model. There are several models. It's just merely an application of formulas. Okay. So NAV computation and performance measures which we need to understand under the chapter mutual funds along with other concepts also. Okay. So mutual fund simply deals with what? The unit holders. Okay. Company deals with shareholders. Mutual fund deals with unit holders. Next concept is portfolio theory and practice, asset pricing theories, portfolio performance evaluation, portfolio revision, and efficient market hypothesis. See, predominantly all these chapters comes under one chapter called PFM. In simple words, in the external world, all these chapters are simply known as portfolio management. Portfolio management. Now, if I am holding one security, one company share, that means I am holding one asset only. If I am holding more than one company share, then that means I am having a portfolio which is a group of securities. See, just like how you are calculating rate of return to the equity share or any other financial asset, just like that, you should also calculate the rate of return of a portfolio. So in this chapter, we need to deal with how much return one should expect for a given level of risk. That's what we need to understand, either for a single security or for a portfolio. For every security, you will expect some return. So how much return I should expect for a given level of risk? So that's what we need to understand. In the similar way, you should calculate the how much return you should expect for a given level of risk, even for a portfolio also. So portfolio management deals with return for risk calculation. Okay, because of that reason, you need to understand how to calculate rate of return of a portfolio and the risk of a portfolio. There are so many statistical formulas which we need to use to handle this particular chapter called portfolio management. In this chapter, we need to understand Markovitch portfolio theory, capital market line, security market line, which is nothing but capital asset pricing model, and arbitrage pricing theory, levered beta, unlevered beta. See, all the formulas are statistical formulas. Just we need to understand such formulas. It's simply an application of statistical formulas, and sometimes we need a lot of interpretations. Okay, that's regarding portfolio management. Expecting return for a given level of risk. Okay, already one concept is covered at CMA interlevel, which is capital asset pricing model, but we need to understand the depth of such capital asset pricing model in this chapter, portfolio management. Okay, so these are the next areas. Financial risk management. You know, dear students, financial risk management means how to manage our risk. See, being an investor, when you are investing a lot of money in the stock market, you should manage your risks. Why? Because such investments are subject to what? Fluctuations. Such fluctuations should be managed with what? Some contracts. So such contracts should be entered by every investor in order to mitigate risk. See, such type of contracts are technically known as derivatives. See, this is what? Derivatives. So look at this chapter, risks in financial market. First of all, you have to understand that. Then financial derivative instruments for risk management. There are so many agreements, contracts, derivative contracts for mitigating the risk, like option contracts, future contracts. See, option contracts which deals with stock, and option contracts which deals with interest rate. Like that, we have several strategies which we need to apply for mitigating the risk. Hedging strategies. For earning profit, we'll use arbitrage strategies. Okay, stock futures, index futures. Okay, like that, we need to understand several concepts in this chapter called financial risk management. This chapter predominantly deals with what? Management of risk in the stock market, especially, even in the regular financial market, like interest rate risk. Okay, so we need to deal with these areas. Why? Because these investments are subject to market risk. So I should eliminate such risk by entering into these derivative instruments. But nowadays, people are using these derivative instruments as trading. But in fact, these derivative instruments are meant for mitigating the risk, not for entering into business. So this is not meant for speculation, but people are using this particular area for speculation purpose. That means to earn profits. This is not, this particular chapter is not meant for earning profits. The objective of this chapter, the objective of this concept, derivatives, is to mitigate risk and earning profits without risk. Okay, this is regarding financial risk management. Derivatives, a new chapter. You can remember this chapter as derivatives, a very important chapter. Okay, dear students, I need to tell you one important point. Section B deals with 35% of the subject actually. So which means it is going to, I mean, we can get 35 marks out of 100 marks by dealing with these topics. Equity valuation, bond valuation, mutual funds, portfolio management. A very lengthy topic, and also it is loaded with lot of weight. Okay. Now this financial risk management derivatives weightage is 20%. Out of 100, I'm going to get 20 marks. So even derivatives is a big chapter. Okay. The last problematic area is international financial management. You know, international financial management deals with currency market. We have several markets like stock market, money market, currency market. There are other markets also, commodity market, but we are going to deal with stock market, money market, and this currency market. Currency market, you cannot see currency market in the external world. See, this will be operated by banks and other other partners. I mean, there are so many dealers, foreign currency dealers. So through them we can deal with the foreign currency. We can exchange the foreign currency. So there is no designated platform for what this forex market. So even a bank is one of the platform for what trading or foreign currency. So under this chapter, international financial management, nothing but forex market, we need to understand several areas like exchange rate quotations, direct quote, indirect quote, bid rate, ask rate, spread, cross rates, spot market, forward market, and then parity relationships. And also in this chapter, we need to understand derivatives also, currency derivatives, currency options, currency futures. These are the areas which we need to deal with. So in this chapter, purely we will deal with the foreign currencies like dollars, euros, pounds, yen. Okay. So how to handle these currencies, how to identify the currencies, exchange rate, how to identify the currency names, and how to calculate the direct quote and indirect quote, and how to understand those direct quotes and indirect quotes. Those are nothing but exchange rate quotations. When you want to buy one of the currency, you should understand the exchange rate quotation, otherwise you cannot buy it. Okay. So in this chapter, we'll deal with these areas. So this is completely a new area for us. So the weightage is around 15% of the whole chapter. Out of 100 marks, we are going to get 15% of the marks. Okay. The last area is digital finance. You know, this is a regular world. You can see nowadays actually these Paytms, Phone Pays, right? This is nothing but digital finance. So we are not using cash nowadays. We are using digital finance only. So we should understand traditional finance versus digital finance concept, and then we need to understand the regulation and governance from government perspective, and digital finance environment. We need to understand digital finance environment. So this is purely a theoretical concept. The weightage is 5%, very less weightage, but still you should give utmost importance to these theoretical concepts also, because you need to handle multiple choice questions, MCQs. Okay, this is regarding the coverage of all the topics under the subject strategic financial management. So see, more or less they are giving, they are strictly following this weightage percentages with little deviation like 1% or 2% only. In one of the examination, they have deviated a lot. They have given a lot of weightage to this particular area called investment decisions. Around 40 marks were given. In fact, we are supposed to get 25 only, but they have given for 40 marks. But that doesn't matter. In the recent examinations, they are strictly following these weights. Okay, weightages. So dear students, this is regarding all the topics. So predominantly in this subject, we need to deal with stock market, currency market, and money market. Okay. So if you can understand these markets, definitely you can handle these chapters. Okay. This is regarding the subject for strategic financial management. So for better understanding purpose, I'm releasing one demo class. So that is related to your investment decisions topic, which is already covered at CMA interlevel. That's some of the basic concepts like IRR, modified NPV and modified IRR concepts were covered in this particular video. So after this video, you can see that particular video which deals with what the concept of IRR, modified NPV and modified IRR. So just look at that video and how I'm going to teach the subject, you can understand it. So thank you so much, my dear students. Good evening, all of you, dear students. Yes, the next concept is internal rate of return, IRR. Yes, internal rate of return means, first of all, return means profit. Rate of return means percentage of profit. You have to calculate the percentage of profit which is internally included in the future cash flows of the project. Your future cash inflows are loaded with two important components. One is your investment, other one is profit percentage, which is IRR. So I can say one thing. Say for example, we are evaluating 3 years project and we are investing some amount of money today. That's your cash outflow. And for that we are going to receive cash inflows for the next 3 years. These are your cash inflows. So these future cash inflows are generally loaded with two important components called investment and the second one is profit. So every year cash inflow will be loaded with two components, investment and profit. Investment and profit. Now, if you convert this profit into percentage, on compounded basis, that particular profit percentage is simply known as internal rate of return. So in simple words, your future cash inflows are loaded with two components. One is your investment, other one is your profit percentage, which is technically known as IRR. So the future cash inflows are loaded with investment and IRR. So my point is, if you remove this particular profit percentage, nothing but IRR from the future cash inflows, then the balance discounted value, nothing but the present value of such cash inflows should represent your investment. So simply speaking, if I can remove this IRR by discounting the future cash inflows at IRR, then automatically the present value of cash inflows should be equal to my investment. Why? Because if I can remove the internal rate of return from the future cash inflows through discounting, so if I can remove this IRR percentage from the future cash inflows through discounting, then the present value of cash inflows must represent my investment. So that's why if you can discount the future cash inflows at IRR, that means IRR is the discount rate. IRR is the discount rate at which the present value of all the future cash inflows. That means if you can discount the future cash inflows at IRR, so by removing IRR from the future cash inflows, the present value of all the cash inflows must be equal to my present value of cash outflows. Present value of cash outflows, or I can say this will be my initial investment. Initial investment. So I can say IRR is the discount rate at which the present value of cash inflows must be equal to my present value of cash outflows, which means the present value of cash inflows minus present value of cash outflows should be equal to 0. There your NPV is equal to 0. So I can say one thing, IRR is the discount rate at which NPV is equal to 0. That's what IRR. So what is IRR? IRR is the discount rate which equates present value of cash inflows with present value of cash outflows. There your NPV is equal to 0. Yes. So this is the true understanding of IRR. So my dear students, I'm just consolidating the points. The future cash inflows are generally loaded with two important components. One is our investment that we are investing in year 0, and the second component is the profit component which can be expressed as a percentage, that is known as IRR. So prima facie, I can say the future cash inflows are loaded with investment and IRR. If I can remove this IRR component from the future cash inflows by discounting such cash inflows at IRR, discounting will remove IRR, then the present value of all the cash inflows must be equal to my investment portion. So that's why at the IRR discount rate, present value of cash inflows should be equal to my initial investment or present value of cash outflows. There your NPV is equal to 0. So simply speaking, IRR is the discount rate at which NPV is equal to 0. Let us consider one example to understand this IRR. I am taking 1 year project life just for the sake of convenience. And here is my investment 1 lakh rupees. This is my initial investment. And at the end of first year, I am going to get 1,15,000 cash inflow. This is my cash inflow. This is my cash inflow. Okay. Now, my dear student, prima facie, by seeing this number, anybody can say that 1 lakh rupees is added with 15,000 profit. If you can convert such 15,000 profit into percentage on my investment, that should be 15% because it's a 1 year project life. So simply I can say that 15% is my profit percentage. So my point is, this cash inflow should be loaded with my investment amount of 1 lakh plus IRR of 15%. Anybody can say this, right? Why? Because prima facie, by seeing this number, since it's a 1 year life, I can easily calculate my IRR percentage. Generally, this is not possible for project life which is more than 1 year. Okay. See, for the sake of better understanding, I have taken 1 year project life here. Now, if you can discount this cash inflow of 1,15,000 at 15% rate, because that's an IRR, such 15% will be completely removed. So 1,15,000 into 1 by 1 plus, I'm using what the present value factor 1 by 1 plus r whole to the power of n, 0.15 whole to the power of 1. Yes. Simply I can say 1,15,000 into 1 by 1.15, this will be 0.86956. Multiply this number with 1,15,000, you'll get 99,999, or I can say 1 lakh rupees. This is my present value of cash inflow. What's your observation, my dear students? Initially, the cash inflow is 1,15,000. After discounting such 1,15,000 cash inflows at IRR of 15%, I got present value of cash inflow of 1 lakh. So I can simply say that I have successfully removed the IRR portion from the future cash inflow and I got present value of cash inflow of 1 lakh. And here, this is exactly equal to my initial investment of 1 lakh. If I deduct this initial investment from my present value of cash inflow, then I will get an NPV of 0 value. Okay. So this is what IRR is all about. So have you observed one thing? By discounting the future cash inflow at IRR rate, I got my NPV which is equal to 0. So I can say that IRR is the discount rate at which NPV is equal to 0, because IRR is a profit percentage. If you can remove profit percentage from the future cash inflow, remaining portion must represent my initial investment. That's why at that rate, my NPV should be equal to 0. Okay, this is regarding the conceptual and explanation regarding IRR. Now, how to calculate this IRR? Generally, for a 1 year project life, it is very easy for us to calculate IRR, but for the projects with multiple years life, I cannot simply calculate IRR. It should be calculated by the use of several formulas and a conceptual work, right? So let me show you how to do it. IRR. If the cash flows are equal, I can use annuity method for calculating IRR. If the cash flows are unequal, then I can use trial and error method. trial and error method. Okay. So if the cash flows are equal, I can use annuity method. If the cash flows are unequal, we can use what? Trial and error method. Yes. So what is this annuity method and trial and error method? Annuity method is already covered at your CMA inter level, and we are going to cover trial and error method, and also while solving the remaining problems in the study material, I'm going to cover this annuity method also. Okay, right now I'm not going to cover this annuity method, but I'm going to cover trial and error method first of all. Okay, yes. Every capital busting technique must be useful for taking decisions. IRR is a profit percentage that should always be more than my investor's expected rate of return, which means in order to select the project, your IRR should be equal to the expected return called cost of capital. So if IRR is greater than cost of capital, you can accept the project. If IRR is less than cost of capital, you should reject the project. If it is equal to cost of capital, it is up to you to decide whether you can accept the project or not. That means may or may not accept the project. Okay. So copy this content completely. Internal rate of return. Yes. Dear students, let us handle one problem related to this IRR concept under trial and error method. Look at this illustration number 13. Consider the following information in respect of a project. Project cost is 1,10,000. Cash inflows, year 1 60,000, year 2 like that. For 4 years the cash flows are given, and these cash flows are unequal. So I must use trial and error method for solving IRR. Calculate the internal rate of return. So you are supposed to handle internal rate of return concept. Yes. Here is the question. Illustration number 13. Under trial and error method, you should go for guesswork, nothing but, yes, there is no specific discount rate here. So you must start with first guess rate. Generally, the first guess rate will be started with 10% by assuming that at least we can earn 10% return from any project. If at all, if your IRR is less than 10%, then that is our fate. Why? Because we are earning very lesser return. Okay. So generally for any problem, your IRR will be more than 10% only. So it will always be started with 10% rate of return for calculating IRR. Okay. Calculation of IRR. So this particular concept is already covered at CMA interlevel. It's just a repetition actually. You just try to recollect your memories from the CMA interlevel. Again, I'm just explaining every point, but try to recover your points also. Okay. Here, cash flows. The first guess rate should be 10% by assuming that at least I can earn 10% rate of return from the project. Under trial and error method, you should assume the first guess rate, first discount rate from your analysis. Okay. So here is my first guess rate 10% and present value of cash flows. 0 year, 1, 2, 3, 4, 4 years. My investment is 1,10,000. First year inflow is 60,000. Second year inflow is 20,000. Third year 10,000. Fourth year 50,000. So I'm taking first guess rate, 0 year factor 1. So please calculate NPV at your first guess rate. If your NPV is equal to 0, this 10% becomes your IRR. If your NPV is positive, then go for another discount rate because there is an inverse relationship between discount rate and NPV. If you can increase the discount rate, NPV gets reduced. So if your NPV is positive at first guess rate, then increase your next guess rate, so that in case again if you get positive NPV, then you go for another discount rate until you get 0. In case if you get negative NPV, then go for interpolation method for calculating IRR. So how to do that, I'll explain it. 0.909, 0.826, 0.751, 0.683. Hope you can refer the present value factor table for 10% discount rate. 1,10,000, 60,000 into 0.909, 54,540. 20,000 into 0.826, 16,520. 10,000 into 0.751, 7,510. 50,000 into 0.681, 34,050. Total minus 1 lakh, it will be 12,620. That's my positive NP. Was it 1,10,000? Okay, sorry. Minus 10,000, it is 2,620. This is my positive NPV. 16,520, 7,000, 54,540, 7,510, 34,050. I have taken 150. 50,000 into 0.68. 34,150. Yeah, it's the wrong number. 34,150. It will be 2,720. Now go for the next guess rate. Generally, my choices, the next guess rate should be with 10% deviation. In the study material, they have taken 12%. I'm not sure about 12% or 13%. Why? Because I cannot go for multiple guess rates. Instead of that, I'll go ahead with 10% deviation. So you'll get approximate answer that will also be considered in the examination solution. You know, dear students, in the examination, you are supposed to take guess rates, but such guess rates are generally given in the examination paper. Okay. So don't bother about these guess rates. Those rates will be given in the problem itself on the main examination. Okay, I'm taking 20% guess rate. So your answer will be slightly different from your study materials answer. If you can take 12%, you'll get exactly the answer which is equal to your study material. Okay. So let me show you the present value factor rate from study material. I mean the present value factor table at 20%. Here are the factors: 0.833, 0.694, 0.579, 0.482. Yes, this one is one. Present value of cash flows: 1,10,000. 60,000 into 0.833, 49,980. 20,000 into 0.694, 13,880. 10,000 into 0.579, 5,790. 50,000 into 0.482, 24,100. Total 93,750 minus 1,10,000. It will be minus 16,250. So we got negative NPV at 20% discount rate and positive NPV at 10% discount rate. Yes. Now your IRR lies in between 10 and 20%. So you can use interpolation method for handling for calculating IRR using interpolation method. There is a formula for calculating IRR using interpolation method. IRR is equal to L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. Your lowest guess rate is 10%, 0.10. NPV at L1 is 2720 divided by 2720 minus of minus 16,250. Into 0.20 minus 0.10. $2,720 divided by 16,250 plus 2,720, 18,970 into 0.10. 0.10 into 2,720 divided by 18,970 plus 0.10, 0.1143 or 11.43%. This is my IRR. They got 11.28%. This is an approximate answer. If you can take 12%, you'll get accurate answer, which is equal to your study material. That's okay. This is also an acceptable answer. Why? Because nobody can guess that 12% in the examination if that was not given in the if it is not given in the examination. Okay. So write the solution. Yes. With this, we understood how to calculate IRR. Now, my next job is to calculate modified IRR. We need to understand modified IRR concept. See how to calculate modified IRR. I'll show you the process which is given in the study material. We have a process regarding this modified IRR computation. Yes. Here is the process. Before going for this, I need to tell you one important point in IRR. At IRR discount rate, profitability index is equal to 1. Why? Because at IRR rate, present value of cash inflows are exactly equal to present value of cash outflows. So the numerator and denominator term in profitability index is same, so that you'll get one profitability index. So at IRR discount rate, profitability index is exactly equal to 1. Okay. Here is the process to calculate modified IRR. So these are the following steps you should follow strictly. Calculate the future value of each cash flow from the project by using cost of capital as a compounded rate. So convert all the year's cash inflows into terminal year project ending life by using cost of capital as a compound rate, reinvestment rate. Calculate the aggregate future value, may be called as terminal value. So I must calculate terminal value by using cost of capital as a reinvestment rate. So convert all the year's cash inflows into terminal year. Calculate the initial investment in case of conventional cash flows project. Conventional cash flows means there will be one cash outflow in year 0. Or present value of all cash outflows in case of non-conventional cash flows project. Non-conventional cash flow project means such project involves multiple cash outflows in the project life. Okay. So if you can see single outflow in the whole life of the project in year 0, then that is conventional cash flow pattern. In case if you can see more than one cash outflow like that, like in year 0, there will be one outflow. At the end of second year, there will be another outflow. At the end of fourth year, there will be another outflow. Like that, if you can see multiple cash outflow, then such cash flows pattern is known as non-conventional cash flows pattern. So what's your job? In case of non-conventional cash flows, calculate present value of all cash outflows. Ultimately, arrive initial investment if it is conventional cash outflow, conventional cash flow, arrive present value of cash outflows. Simply speaking, in zero terms, I need what? Present value of cash outflows or initial investment. Okay. Determine the discount rate that equates the present value of the aggregate future value with the initial investment or present value of all cash outflows. Such rate will be modified IRR. See, instead of understanding this, you better go ahead with this formula. Actually, they are saying at modified IRR, present value of cash outflows should be equal to present value of all the future cash inflows. Present value of all the future cash inflows, nothing but present value of terminal value. This is simply present value of terminal value. What they are trying to say is terminal value into 1 by 1 plus modified IRR rate. Okay. So if you can discount terminal value at modified IRR rate, that present value of terminal value should be equal to present value of cash outflow or initial investment. This is one way of computing the modified IRR. The other way is modified IRR can be calculated by using this formula. For conventional and non-conventional cash flows, we have two formulas here. Okay. We have two formulas here for conventional and non-conventional cash flows. Look at this modified IRR formula for non-conventional cash flows. Nth root of, I said what? Nth root of aggregate future value of cash inflows. Nothing but terminal value. Okay, this is terminal value divided by aggregate present value of cash outflow. This is initial investment or present value of cash outflows. Okay. Whole term, this whole term minus 1. That gives me modified IRR. Okay. Or in case of conventional cash flows, I'll write initial investment instead of present value of cash outflows. So nth root of aggregate future value of cash inflow. So nothing but this is also terminal value divided by initial investment. Nth root of terminal value divided by initial investment minus 1. You should also deduct minus 1. That was missed here for non-conventional cash flows. Minus 1 subtraction is common. Okay. These are the formulas for calculating modified IRR. See, only by solving the problem you can understand this particular concept. Yes, I'll show you how to do it. Without wasting your time, I'll straight away jump into the problem. Why? Because we don't have enough more time to handle all the concepts. Okay. Sometimes I may not take examples to explain some of the concepts. Why? Because these concepts are already covered at CMA inter-level. It's just a repetition, no issue. You can understand these concepts again while solving the problems. Okay. So now here is the problem, this illustration number 15, which gives you better understanding regarding modified IRR. Let me show you how to apply this particular process. Just now we understood one process, right, for calculating modified IRR. How to apply that particular process for calculating modified IRR. We have a formula, right? Nth root of what? Terminal value divided by present value of cash outflows minus 1 for non-conventional cash flows. Nth root of terminal value divided by initial investment minus 1, that is for conventional cash flows. So my first job is to calculate terminal value. How to calculate terminal value? Convert all the year's cash inflows into terminal year by using cost of capital as the available reinvestment rate. Once we get the terminal value, it is very easy for you to calculate modified IRR. So here is a problem, illustration number 15. Calculate the aggregate future value from the following information. Calculate, see, ignore this. From the following information, calculate modified IRR of the project. Initial outlay is 1 lakh, cost of capital is 12% per annum, life of the project is 5 years, and cash inflows from the project are 20, 30, 40, 50,000 and 30,000. So we have 5 years inflows here. Okay. So I must consider 5 years life. So for 5th year ending, I mean by the end of 5th year, I must calculate terminal value. That's my first job. Okay. Illustration number 15. So in step 1, I should calculate terminal value. Okay, then fine. Let me handle this part here. Calculation of terminal value. Let me take the columns. Year, cash flows, reinvestment period. For how many years you are reinvesting your cash flows. Calculation and terminal value. Okay. So 1, 2, 3, 4, 5. Two, 3, 4, and 5. The first year cash inflow is 20,000. Second year 30,000. Third year 40,000. Fifth year 50,000. Fourth year 50,000. Fifth year also, fifth year it will be 30,000. Yes. First year ending inflow can be reinvested for 4 years because second, third, fourth and fifth. 4 years, 3 years, 2 years, 1 year and 0 years. Cost of capital should be your reinvestment rate. Okay. So 20,000 into 1 plus 0 point. The cost of capital rate is 12%, 0.12 whole to the power of 4. It is 30,000 into 1 plus 0.12 whole to the power of 3. 40,000 into 1 plus 0.12 whole to the power of 2. 50,000 into 1 plus 0.12 whole to the power of 1. And 30,000 into 1 plus 0.12 whole to the power of 0. So let us take the numbers. 1.12, 1, yeah, that is 2 actually. 2, 3, 4 into 20,000. It will be 31,470. Two, 3 into 30,000. 42,148. $50,176. 56,000. 30,000. Add these numbers. $2,09,793 or 794. This is my terminal value. So what is my next task? Say it's a clear case of conventional cash flow. Initial investment is clearly given. So modified IRR, MIRR is equal to, for conventional cash flows the formula is nth root of terminal value divided by initial investment minus 1. N means life of the project. Fifth root of your terminal value is 209,794. Divided by your initial investment is 1 lakh. From this whole term, I have to deduct 1. See, 2,09,784 divided by 1 lakh. It will be 2.09794. Fifth root of 2.09794 minus 1. So, how to take this number out of this fifth root? We have a format for calculating this. Nth root of any number. I'll show you. Take that number from nth root and apply square root for 15 times. Apply square root 15 times. Step 2. Step 1 minus 1. Step 3. Step 2. Divide by n plus 1. Step 4. Into is equal to for 15 times. If you can apply this process, you can easily get the answer. Okay. Yes. Here is your number 2.09794. So type that number in your calculator. 2.09794. 2.09794. Apply square root 15 times for this number. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Subtract 1 from it. Divide by n means nth root. N means here it is 5. Plus 1. Into is equal to 1 time. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. I got 1.1597. 1.1597. So this will be 1.1597. I got another number 35, something like that. No need to take that. It will be 0.1597 or 15.97%. So even in the study material, we got the same number. So just copy this part completely. Yes. With this, we understood modified IRR concept. Now, let us understand modified NPV. That's our next concept. Say, I'll tell you how to calculate this modified NPV. First, under step number 1, calculate the terminal value by using reinvestment rate as a compound rate. Convert all the years cash inflows into terminal year, just like in the modified IRR concept. We should convert all the years cash inflows into terminal year by using available reinvestment rate as a compound rate. Calculate terminal value by converting interim cash flows into terminal year by using available reinvestment rate. Once we get the terminal value, then discount such terminal value by using cost of capital as a discount rate. Calculate the present value of terminal value by using cost of capital as appropriate discount rate. Okay. So once we get the present value of terminal value, then you can easily calculate modified NPV. Modified NPV is equal to present value of terminal value minus initial investment. It's a simple process to handle. Just copy this. Modified NPV computation. We have one problem in this regard. Let us handle that problem. Here is the question. Illustration number 16. A company is contemplating an investment project of 4 years with an initial outlay of 1,20,000. The cash inflows estimated from the project are 30,000, 40,000, 30,000 and 36,000, 4 years life. The estimated rates at which the above cash flows will be reinvested are: first year ending cash flow can be reinvested at a reinvestment rate of 8%, second year 9%, third year 10%, fourth year 9%. The cost of capital is 10% per annum. Analyze the viability of the project under terminal value method. My dear students, modified NPV concept is also known as terminal value method. This is nothing but modified NPV. Okay. Yes. So what is your first job? Convert all the year's inflows into terminal year by using reinvestment rate as the appropriate compound rate. Illustration number 16. Step number 1. Calculation of terminal value. The same columns I am going to take along with one additional column called reinvestment rate. Yes. Year cash flows, reinvestment rate, reinvestment period, calculation, and finally the terminal value. Okay, these are the columns. 1, 2, 3, 4. First year ending inflow, it is 30,000. Second year 40,000. Third year 36. The first year ending cash flow can be reinvested for 3 years, second year 2 years, third year 1 year, and fourth year ending cash flow cannot be reinvested again. Fourth year ending cash flow remains fourth year ending cash flow only. Yeah, okay, actually I have taken here 3, 2, 1, 0. Let me take the discount rates 8, 9, 10, 9, reinvestment rates. These are my reinvestment rates. Now let me take the calculation. 30,000 into 1 plus 0.08 whole to the power of 3 to 3 into 30,000. It will be 37,792, 791.